We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. Also joining us today is Marc Knauss. Marc is a certified financial planner with the team at Decker Retirement Planning. I'm Mark Elliott. Glad you're with us. You can always find out more on the website, deckerretirementplanning.com. And every time we start this show, I always tell you, you have the opportunity to download a bunch of retirement information and financial information on the website, Decker Retirement Planning, under the heading of Safer Retirement Education, including Brian's book on retirement, The Decker Approach, 3 Principles of Retirement book, the Checklist Challenge, and a sample income plan. That's 4 of the 12 things you can download right there on the website, deckerretirementplanning.com, under the heading of Safer Retirement Education. It's all there for your information. And then if you get some of that and you have questions, you want to talk with somebody, give them a call. There's no cost. 833-707-3030, 833-707-3030. Might be the most important phone call you make. Certainly today, because we're going to give you some clarity into your retirement picture. Are you on the right track? Do you need to do some different things? Have you already won the game? Do you need to challenge the game a little bit? You need a little bit more. 833-707-3030. Brian, I know you and Marc today are going to be discussing a little bit about how you set up retirement plans, but also about the market. Where are you going today? Where are you starting?
Well, let's start with risk reduction, because right now the markets have crossed a very important barrier. Marc Knauss, you're in the Bellevue, Washington office that we have. Has the S&P crossed the 200-day moving average? And while you look that up, want to just mention that the S&P 500 used to be a very broad, diversified portfolio of stocks. Now, lately, we've had a concentration issue with 7 stocks representing about 28% of the portfolio at its height. Now, when you have that much concentration where 7 stocks, it's called the Magnificent Seven, Microsoft, Google, Apple, Amazon, Tesla, NVIDIA, those kinds of stocks have gotten so high in their capitalization that you really are not as diversified as you think. You think you own 500 stocks equally. You don't. When Microsoft or NVIDIA or Apple or Amazon go down, it has a bigger magnified effect on the typical S&P 500. But we're going to talk about uptrends and downtrends and strategies in retirement. First off, big picture, Mark, there's a huge difference between saving for retirement and using accumulation strategies and being in retirement and using distribution strategies. I'm going to toss it over to you in a second, but I want to just mention that if you're in your 20s, 30s, 40s, and 50s, markets go down 30, 40, 50%, no big deal, because you're getting your income from work. And every 2 weeks, you contribute more money into your 401k that took the hit. You have the 3 to 5 years for the portfolio to recover. And during that period, you have actually benefited from a down market because you're investing into a down market. You're dollar cost averaging into a down market. But now let's flip it. When we are 65 plus years old, you're in retirement, your portfolio is generating a part of your income along with Social Security. Maybe you've got rental real estate, maybe you've got a pension, but your portfolio, your nest egg that's supposed to last you for the rest of your life, when that takes a 30 or 40 or 50% hit, that is a totally different ballgame. Now, the funds from your portfolio are being drawn. You're not adding to it, you're pulling from it. So there's a mathematical principle that goes like this. When you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. One of the principles of distribution planning, and then Mark, I'm going to toss it to you for the bigger, much more broad principles. Number one is you draw income from laddered principal guaranteed accounts for 4 key reasons. Mark, you take the ball from there. What we're going to talk about the 4 key reasons that you draw from laddered principal guaranteed accounts. And again, markets in the last few weeks, we have Tesla cut in half in the last 3 months. We have NVIDIA, one of the big AI companies, that's down more than 30% just in a matter of 2.5 months. Some people are feeling a lot of pain right now because the big leaders that brought them here with accumulation strategies are not using distribution strategies. And so their sleep at night measure is not doing as well. So Mark, take a minute, talk specifically about the 4 key reasons that people in retirement should draw income from laddered principal guaranteed accounts. And then let's talk big picture about distribution planning versus accumulation planning.
Yeah. So one reason why I love the philosophy here at Decker Retirement Planning is our bucket strategy and the way we utilize the principal guaranteed components of safety to provide you the income in retirement. So when you're building out a retirement plan and you're folding in your more conservative guaranteed pieces of a portfolio, imagine the safety that comes from knowing that your income every month is coming from accounts that have no downside risk. The stock market this year is down, it's negative for the year. And since Valentine's Day, February 14th, the S&P is down 8%. The NASDAQ is down almost 10%. Our clients that work with us, their income is not impacted by the market fluctuations. And that's such a tremendous peace of mind that comes from knowing that you're not compromising your monthly income based on what the stock market is doing. The second piece is that when you do a bucket strategy and you're dividing your income from your portfolio up over different time horizons, short-term money, medium-term money, long-term money, it allows you to push more dollars to the back of the plan, to your long-term money, and take advantage of compound interest. So your higher growth strategies are designed for longer periods of accumulation because that's where you get the compound growth. Additionally, with a bucket strategy, it allows you to take advantage of different time horizons. So you ladder into different time horizons. That way, if there's interest rate risk or inflation, you're taking advantage of those risks rather than being subject to them, which is very powerful. And the last piece is that we fold in your risk bucket, and your risk bucket is designed for long-term growth. And when you think long-term growth, you're giving that bucket the longest runway possible to get stock market-like returns, and you can take on more risk on the back end of the plan, all while knowing that in the short term and the medium term, your income is coming from principal guaranteed accounts.
So if we quantify those steps, one is we have tremendous peace of mind by drawing income from laddered principal guaranteed accounts. Now, on that one first point, I want to make sure that clients don't think that we are proponents of life annuities or income annuities. We are not. We hope you never invest in life annuities or income annuities or variable annuities. We don't like them. We don't use them. We try to use this radio forum as a community service to warn you to stay away from those. We are not talking about tying up your money and locking that into a lifetime annuity. We hope you stay away from lifetime annuities, income annuities, variable annuities, all of that. But what we are talking about is laddered principal guaranteed accounts that give you tremendous peace of mind. That's key point number one. Number two, you mentioned, Mark, was compound interest, using compound interest to our advantage, taking money from the shorter term, lower yielding accounts, allowing the higher growth accounts to grow and compound. Number three, you mentioned we are taking 15 to 20 years of income and allowing the risk bucket to grow for 15 to 20 years and replace or replenish what has been spent. So if you've got 1.5 at 65 years old, you pay that out for a period of time, and then you go 15 to 20 years down the road, and then you replenish it with another hit, kind of like shifting gears in your retirement. And then number 4 is we're ultra conservative on the income parts of the bucket. So when it comes to estimates in your plan, we have in bucket 1, we're saying 1% when it's earning 4 times that. And bucket 2 and 3, we're saying are 3 and 4% when they're averaging much higher than that. And then buckets 4 and 5 are averaging a third of what we're showing. So we're being very, very conservative on purpose so that people, being human like they are, they want to hear that they're ahead of schedule, number 1. And number 2, they want to see that their income goes up each year. So Mark, now let's go more broadly. You use accumulation planning. Let's define what that is to get you to retirement. Accumulation planning is using the pie chart, buy and hold, bond funds, diversification, and it's pedal to the metal, risk on part of your portfolio. And we think that that's good. And bankers and brokers are trained as accumulation advisors. They're good at that. That's all that they do. But once you're within 5 years of retirement or in retirement, we recommend someone switch to distribution planning. So Mark, what's the difference? And explain in detail what a distribution plan looks like.
Yeah, this is really key when it comes to your financial phase of life. You originally, when you are young, you just start building up your savings. You're saving and saving and saving, and you're doing everything you can to just build up a little bit of wealth. And then when you have a little bit of wealth, you go and you work with a financial advisor who will put you into a stock bond portfolio that is designed for growth. Its design is to be growth focused, and we call that accumulation. Every year or every 2 weeks, you're putting new dollars into your portfolio and you're adding to your risk bucket. When you get into your late 50s and 60s, and now all of a sudden your portfolio is the largest it has ever been, and your time horizon for retirement and needing that money is shorter than it's ever been. So now you have to think, what is the next phase of your financial journey? And that is, we call it the distribution years. Now you're entering into a time period where your portfolio is going to turn into your paycheck for the next 20, 30, 40 years of your life. And you have to have a different mindset when you're talking about distribution strategies. And it can't be the same strategies that you used for accumulation modeling. It can't be an accumulation strategy that gets you through a distribution phase.
Okay, let's talk about allocation. So in your 20s, 30s, 40s, 50s, a lot of people come to us and they're 100% in the stock market. And then they think that in retirement, they should have a 60-40 or a 70-30 portfolio. Well, Mark, if you've got a 60-40 or 70-30 portfolio, those people aren't sleeping well right now because the markets have taken at least, a lot of these portfolios are down much more than the indexes.
So a good place to stop segment 1 right there, I think, from Mark and Brian. If you have questions, you want to learn more about how this all affects you when it comes to your retirement, 833-707-3030, 833-707-3030. This is super important. When you get into retirement, the markets are down and you're pulling from those market funds, you're losing money pretty quickly, and that's how you run out of money. You got to have a plan and a strategy, and the team at Decker Retirement here to help you figure yours out. 833-707-3030. Brian and Mark back with more of Safer Retirement Radio right after this.
If you only think about taxes once a year, you're doing it wrong. To get the most out of your retirement nest egg, you shouldn't just file your taxes. You need to plan for them. Call Brian now to see what tax opportunities you could take advantage of. 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon. From you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can always go to the website to learn more, DeckerRetirementPlanning.com. You can always call them if you have questions or concerns. Markets are bumpy. What should I be doing? Do I need to tweak something? Do I need to, I don't know. Do I need to rebalance? I don't know. And Brian and Mark don't know either until you have a conversation with them. 833-707-3030 is the number. Again, no cost to chat with the team. They're here to help if they can. 833-707-3030. I'm Mark Elliott. And Brian and Mark talking about risk. Really, the markets are bumpy. What should we be doing right now? So, Brian, back to you.
People don't know what they don't know, Mark. And so we want to make sure that they know that they shouldn't have 60 or 70% of their portfolio. If you're retired or within 5 years of retirement, we hope you come see us just based on this one principle of allocation. You should not have 60 or 70% of your portfolio invested in the stock market when you are in retirement or within 5 years of retirement. We're a math-based firm. We can take your numbers and plug your plan in place so that you can see that. And Mark, confirm this to our radio listeners. Most everyone that comes in, when they see what kind of income that we can produce for them, 95+% of the people are ecstatic, and it's more than they expected. Isn't that true?
I love our second meeting where we take the information that we gather from a client in our first meeting and we put it into a plan and show a client what they could be receiving in monthly income based on all their sources, based on their portfolio, Social Security, pension, rental income, any other fixed income sources that they might have. And it opens up the conversation to so many additional options. We start talking about early retirement, and we start talking about legacy planning, and we start talking about gifting strategies, and we start talking about taking those trips that clients have always wanted to go on. And it allows people to start dreaming bigger than what they've been able to dream before because we see it on paper, because for the first time in their lives, they're seeing what is possible in their future. And it's such a wonderful conversation to have with clients.
Now let's connect the dots. They're getting more than they expected. And typically the exposure to risk is not 60 or 70%, Mark, but it's 25% approximately. Yeah. So they're taking a third of the risk and they're getting more income. Who doesn't want that? We want to make sure that clients are able to see that risk reduction, number one, should be quantifiably much less than what they're taking, number one. Number two, let's talk strategic. Now, Mark, you mentioned that we are in kind of a situation now when market valuations have gotten to where they're above 30 times trailing earnings. That's only happened 4 times. 1929, markets were flat for 17 years. 1964, markets were flat for 18 years. 1999, markets were flat for 14 years. The 4th time, we hit 32 times trailing earnings in October of 2021. That means that for the next 10 to 15 years, we're looking at a flat market cycle. And that's with 120 years of history saying so. Now, we hope for the best, we plan for the worst, but the worst case, that would be devastating to a lot of retirees. So there are strategies out there that allow you to make money in that flat market cycle where markets go 2 steps forward, 2 steps back, up, down, choppy for 10 to 15 years. Mark, I'm going to have you explain the two-sided strategy in a second. I want to have you go into detail on that. But passive investment strategies, let's define what those are. Those are buy and hold strategies of stocks, indexes, ETFs, or mutual funds. Those historically, with 120 plus years of history, will yield a zero return, zero in a flat market cycle. A passive investment strategy will hurt you in retirement. And you multiply that pain by having allocations of 60 or 70%. But there's one way that we lower risk is quantitatively. We just covered that. Second way we lower risk for our clients in retirement is strategically. So Mark, educate our radio listeners about momentum strategies, how they work, why we use them. Go A to Z on this.
Well, even in a down market cycle, say, for example, the dot-com crash of 2000, there were still sectors in the stock market that performed well, that were still getting positive rates of return. And a momentum strategy allows you to, using technical indicators, to identify those sectors and move into those sectors. So even in a down market cycle, like we saw in 2000, we saw in 2008, we saw in 2015, 2018, 2022, momentum strategies are able to identify which indexes, which sectors, and which stocks have positive momentum. What do I mean by momentum? It's momentum relative to cash. So every stock, index, sector is given what's called an RSI score, or a relative strength score, relative strength indicator. And it's how that position is doing relative to cash. If it's moving slightly faster than cash, it has a low RSI score. If it has relative strength significantly higher than cash, it's given a higher RSI score. So momentum strategies are able to identify where the momentum is in certain sectors and in the markets, and it pivots out of a lower moving strategy into a higher moving position. So it's not market timing, it's not buying and holding, it's not selling high, buying low. It is identifying which sectors are moving the fastest and moving into those sectors.
Mark, I want to start even before that. When we look, we're a math-based firm. We're fiduciaries to our clients. We take very seriously the studies that go into picking the strategies we use. First of all, biggest study ever done was done by Jake O'Shaughnessy, What Works on Wall Street, in his study since 1950. The biggest returns in the equity markets strategically are number 1, 2, 3. They're actually the top 15 are all momentum, relative strength, and sector rotation. But those are all kind of the same thing. So every stock is ranked 0 to 100 based on relative strength, like you said, Mark, 0 to 100. And momentum has you owning the top relative strength stocks until something better comes along, and then you buy that. You rotate into it. It is sector rotation. It is momentum. It is relative strength investing. So in 2001 and 02, Mark, like you said, S&P was down 50%, NASDAQ was down 70%. And during that 3-year period, had you used momentum, you would have owned all the sectors, Mark, like you said, that were going up. That was real estate, gold, silver, energy, pharmaceuticals, biotech, healthcare. All those stocks made double-digit gains each year for 3 years. You would never have known that most people, your friends and neighbors, would have got their 401ks cut in half. Then markets bottomed in March of 03. You would have rotated into what exploded to the upside for 4.5 years, which was emerging markets, small caps, technology, and semiconductors. They made a lot of money. And then rolling into 2008, you would have been stopped into cash because momentum has you buying what's going up. Well, in 2008, everything went down except for Treasury bonds. Treasury bonds were up 22%. So you would have owned cash, heavy cash portfolio and Treasury bonds. In 2022, that was a most recent hit. 2022 S&P is down 19%, Nas down 33, bonds were down 20, commodities were hit. But remember, Russia had invaded Ukraine and energy exploded. So momentum had you in whatever was going up, which at that time was the frackers, the drillers, the pipelines, the crude oil companies, the natural gas companies. They made 15 to 20%, while most people lost at least 20 that year. So this is something that allows clients strategically to lower their risk dramatically. We've talked in the first segment about quantitatively lowering their risk. Now we're talking strategically, how to strategically lower their risk. In the next part, Mark, we want to talk about eliminating a risk that is called interest rate risk. Mark, you mentioned in the very beginning about one of the differences between accumulation planning and distribution planning is where we are in the interest rate cycle. We're going to hit that next.
So again, if you'd like to chat with the team at Decker Retirement about anything regarding your portfolio, regarding your retirement, where you are on that road, are you good? Do you need to do a little bit more? How do you figure all that out? Well, Brian and the team at Decker Retirement certainly can help. It's 833-707-3030. Again, no cost to you, 833-707-3030. Back with more of Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement. We're back with more right after this.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. You can go to the website to learn more, DeckerRetirementPlanning.com. Again, there are 12 different things you can download, including Brian's book on retirement, the Decker Approach book. Those are all under the heading of Safer Retirement Education on the website, DeckerRetirementPlanning.com. You can always give them a call with questions, 833-707-3030. Maybe you're getting real close to retirement. Maybe you're already retired and you got some concerns. 833-707-3030. All right, Brian, you and Mark are going to get into a little bit about interest rates and how those factor in, right?
Right. Interest rate risk is very real, and market applies to portfolios. Imagine if a client had about a 60-40 or 70-30 portfolio when the interest rate cycle's going up versus down. So take us through what interest rate risk is, Mark, and how that affects someone in retirement.
Sure. So whenever you're thinking about bonds in your portfolio and interest rate, it's kind of some industry jargon here, but think of it kind of like a teeter-totter. When interest rates go up, the value of bond funds in your portfolio will go down, and vice versa. When interest rates go down, the value of the bond funds in your portfolio will go up, because interest rates and bond funds have this inverse relationship. So from 1940 all the way up to 1980, we saw interest rates go through the roof. I mean, you think back to the 1970s, 1980s, and people were buying their first home paying, 15% interest on their mortgage. And then fast forward to 2020, when interest rates bottomed out in August of 2020 at 0.47%. The US Treasury could borrow money for the next 10 years at less than 0.5%. Well, if you think of that on a risk spectrum, the worst time to buy a 10-year Treasury was at the extreme low, because that was the maximum risk in bond funds. So looking forward, there's this rule in the industry. It's called the rule of 100. And this is how it works. You take your age, you divide it by 100, and that tells you the percentage of your portfolio that should be in bonds. So say, for example, you're 60 years old, you take 60, divide it by 100. So 60% of your portfolio should be in bonds. And as you get older, then your percentage or your weighting of bonds gets larger and larger. Well, say you're in a bond-heavy portfolio and we're in a rising interest rate environment, that means more and more of your portfolio is at risk due to interest rate expansion. We don't like bonds. We don't use bonds in our portfolio because of interest rate risk. And there's better alternatives to bonds that are safer, principal guaranteed, with no downside risk in their portfolio.
So I want to give some dates on this. From 1940, the 10-year Treasury was at 2%. 1980, 40 years later, it peaked at almost 15% on the 10-year Treasury. Then from 1980 to 2020, nice 40-year decline in interest rates, went from almost 15% on the 10-year Treasury to 0.47, like you said. 40 years up, 40 years down. Well, bond funds, you do not want to own bond funds while interest rates are going up. Now, since in the last 4 years, anyone who's owned bond funds have lost about 30% of their portfolio. And still, bankers or brokers, the accumulation guys, say that that's the default to the no risk, the safe part of your portfolio. Well, that doesn't work in a rising interest rate environment. Now, Mark, specifically, what's happened since the Fed started lowering rates in September of 2024?
Yeah, I was going to point that out, that the Fed is starting to lower rates, right? They're cutting rates and they're saying, oh, we got to do something about this inflation. We got to cut rates. But the reality is, if you look at the 10-year Treasury, the longer term interest rates have actually gone up since the Fed has started cutting rates. A really interesting phenomenon there. So even though the Fed is cutting rates, we're seeing long-term interest rates continue to go up, putting more and more clients' bond positions at risk of losing money.
Okay, and that's something that's important, because if you own bond funds and you expect that rates will be going down, there's two rates. One is controlled by the Fed. It's the open market rate that's gone down. They control that. But the second is the open market rate. The open market bond rate is controlled by the open market, people buying and selling bonds. Well, they have these bond auctions to sell their treasury bonds, and people are demanding a higher rate of return. There's 36, soon to be 37 trillion reasons why interest rates are going higher and why tax rates will probably have to go higher. It's our deficit. It creates more risk, and therefore bond holders are demanding a higher yield on their bond positions for U.S. Treasuries and also bonds in general. So we're in a rising interest rate environment. We want to warn you that if you own a bunch of bond funds, that's hurt you in the last 5 years and will continue to hurt you as long as the interest rate cycle is going higher. The last two cycles, going back to 1940, have gone 40 years, not 4 years, 40 years. And so we want to just tell you, and Mark, you nailed it when you said people don't know what they don't know. There's many great options for people that are principal guaranteed, less risk, and offer a much higher return. So Mark, now let's go to the second thing that we want. We talked about lowering clients' risk. We talked about three ways we do that. One is quantitatively. Instead of this ridiculous 60, 70% exposure to people's risk portfolios in retirement, we think that's insane. We'd recommend it go down to 25%. and strategically lowering their risk using momentum strategies in their risk portfolio that are able to make money in up markets and down markets, because you're cherry picking the best parts of the market in up markets, and you're buying only the sectors that are going up in down markets. Now, right now, the current down market has us favoring gold, silver, and healthcare. Those are the clear standouts so far in this down market. So, Mark, we talked about quantitatively lowering their risk, strategically lowering their risk, and completely eliminating interest rate risk. Now, let's talk about an important part of portfolio management, which is downside protection. We talked about the buy and hold passive strategy, how in a flat market cycle, like we believe that we're in, the next 10 to 15 years being flat, that's devastating. And to avoid flat returns in the flat market cycle, to have active management, we covered that with momentum strategies. Let's talk about this third part of this. Let's highlight ways that people can make money with principal guaranteed accounts. Let's go into detail about what's out there. In AI specifically, there are some principal guaranteed accounts that you have different indexes that you're able to, and we want to, let's be very cautious and clear here. We mentioned that we are not interested in variable annuities, income annuities, life annuities, or income riders categorically. But there's some principal guaranteed accounts that people should know about. Two areas. One, instead of just looking at the banks for CDs, Mark, we look at insurance companies for CDs, and most of the time we're getting a higher rate from insurance company CDs than bank CDs. End of story. I mean, we'll just move on from that. But in our search for yield, we want to explore all areas, banks and insurance companies. So in a 3-year, 4-year, 5-year CD fixed rate, we're getting higher rates from insurance companies. But on 7 and 10-year principal guaranteed options, the variable rate investments are offering higher rates. So Mark, go A to Z on this.
With an indexed account like Brian is talking about, number one, you have no downside risk. So you have a guarantee from a financial institution that no matter what happens in the stock market, no matter what happens geopolitically or here at home or abroad, none of the headline risk will cause your portfolio to lose money or will cause your accounts to lose money. Additionally, with that, you can invest in different indexes and different strategies that have significant upside potential as they rotate between stocks, equities, fixed income, bonds, and also commodities. So these indexes identify where the trends are, where the momentum is, and it will move you into those different indexes, those strategies based on technical patterns.
Mark, I want to interrupt you right there and just add for our radio listeners how important that piece right there is. In 2000, 01, and 02, these principal guaranteed accounts that allocate between stocks, bonds, and commodities, stocks got creamed, but bonds and commodities did well. So in 2000, 01, and 02, the principal guaranteed side of your accounts would have done very well. And then in 2008, stocks and commodities got creamed, but bonds did well. So there's some years where you do get a zero because that's part of guaranteeing your downside. If the index loses money, you cannot, but your risk has gone down because you're not investing in one market, you're investing in 3.
Right. We have a number of different strategies that allow you to diversify. So like Brian mentioned, you're not pigeonholed into just one strategy. We go out to the WINK database, W-I-N-K database, and identify the best performing strategies offered by the best and strongest companies out there. And our criteria is what is the best strategy for a 7-year period? What is the best strategy for a 10-year period that can get the best results for our clients?
And Mark, most consistent and also A-rated, these are the healthy companies, strongest companies too. And I want to go in the next segment, Mark, let's jump into details about some of these returns and good years, bad years, but let's talk about the different indexes that are out there.
So when we come back, that's where Mark and Brian are going, right here on Safer Retirement Radio. Again, if you have questions or concerns, it's 833-707-3030. Maybe you want to rebalance your portfolio a little bit about the way the guys are talking today about the markets. 833-707-3030. Brian J. Decker, Marc Knauss, back with more of Safer Retirement Radio right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Marc Knauss of Decker Retirement Planning. Again, if you want to find out, maybe download some of the information on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. You can get Brian's book, The Decker Approach, book on retirement, the 3 principles of retirement book, the checklist challenge, sample income plan. That's just 4 of the 12 things you can download right there on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. You can always give them a call at 833-707-3030 if you want a little bit more clarity into your retirement picture, 833-707-3030. I'm Mark Elliott. All right, Brian J. and Mark, you guys are going to get into indexes a little bit in this final segment.
Yeah, we're going to get into the weeds on this. So the 7 and 10-year principal guarantee in the laddering that we do, we're getting much higher rates, far higher than CDs, by using equity indexed accounts that Mark's talked about. These are principal guaranteed accounts. They allocate daily between stocks, bonds, and commodities. We talked in the previous segment about how that brings the risk down, because there's many years where the stock markets have been ugly. Mm-hmm. And the bonds and commodity section is made very good money. So now we want to get more specific. So Mark, I'm going to toss some questions to you. Instead of one index in these equity indexed accounts, the Generation 4 indexes that we use have 3 indexes or more. So in this case, I'm looking at a 7-year that we use. It's got 3 different indexes. We split the accounts. Now, by the way, when I say 3 indexes, we split the account between half the money comes, and these are all no fee indexes. So that's very important. We want to make sure that there's no fees on the indexes. Fees are a very important part of what we look at in research for our clients as true fiduciaries to our clients. Make sure that there's no fees, and also there's no bonuses. Mark, why do some companies offer bonuses?
You know, it's a fun story on the front end. Hey, listen, if you sign up with this product, I'll give you a 15% bonus or a 18% bonus. But what happens is, and these companies, they know the deal. They can do math on their end. So they know that what they do is it's like putting lipstick on a pig. They'll hamper results, and they'll hamper performance over the next 7 to 10 years in that account, simply because they gave you a bonus on the front end. And we have so many clients who come to us, and they're in a strategy like this, and they're so frustrated that over the last 5 to 7 years that they've had these strategies that they've made no money. They got the bonus on the front end, and they've made no money in the account. So we don't use bonuses.
Yeah, we want to steer away from those. So we got a lot to cover. So we're going to cover this quickly. Let's talk about point to point. Half the money comes due and locks in every 1 year. Half the money comes due and locks in every 2 years. That's very important. That means that if you start with 100,000, you get your 7 or 8%. On the 1 year part, it locks in. So now 108,000 is your new floor from which you cannot go lower. It's your principal guaranteed floor. Every year, half your portfolio locks in on 1 year. Every 2 years, the other half locks in every 2 years. The reason that we split that is because you get a higher rate with a 2 year than you do with a 1 year. Now, we're using indexes that allocate between three markets, stocks, bonds, and commodities. With that kind of diversification, we're not worried too much about the 2 years having 18 months of good returns and then tanking for a zero return over 2 years. But that is the risk. Now, Mark, I want to have you explain what a very important component of this, and that's called participation rate. Want to explain to our radio listeners what that is and use the analogy of the mortgage rate. I've heard you use that before. That's really good.
So with a participation rate, these are going to be focused more on how much leverage you have as it applies to the performance of the index. So Brian had mentioned that not only are we diversifying you between different time horizons, but we're also diversifying you between different indexes as well. And each one of those time horizons and indexes gives you a something called a participation rate. It tells you how much you participate in the growth of the index. So for example, if the S&P 500, which is an index, if it goes up 10% in value and you have a participation rate of 50%, well, you would get 50% of the 10% growth. So you would get a credit of 5%. But if you have a participation rate over 100%, now it acts as a multiplier. So if the S&P 500 were up 10% and you had a 150% participation rate, you take 10% growth times 150%, that gives you a credit to your account of 15%. So the participation rate is a very powerful formula that gets applied to your account as it relates to the performance of the index and how your account gets credited.
Okay, and want to make sure that clients know that a good analogy of this is, let's say you had a 6% mortgage, Mark, and rates have dropped to 3%. What do you do without even thinking?
Oh, yeah, absolutely. And we're seeing this all over the place is you refinance it, right? If you've got an old, expensive, non-performing mortgage and you can refinance it to a new interest rate that saves you money on a monthly basis, why wouldn't you do that?
That's a no-brainer. So what these participations do, participation rates have gone up in the last 4 or 5 years. So now the timing is very good. The multipliers are higher. The indexes are more diversified. They're generation 4. And now here's the returns on a 7-year. For the last 10 years, that one index is averaging over 11% on the 2-year per year. The other is averaging over 7.5% on the 1 year. The second index is averaging 9.5 on the 2-year, and then the 1 year is averaging about 7%. But then we get into AI. The 2-year average annual returns are over 23%, and the 1 year is averaging over 17. These are S&P-like returns in principal guaranteed accounts. People don't know what they don't know. This is a huge reason for them to come talk to us. And on the 10-year, Mark, this is same thing. On the 10-year, we're looking at 3 different indexes split equally 1 year to 2 year. The average returns on on 2, 4, 6 on all 6 of these. So 3 1 years, 3 2 years. They're all double digits, all of them. So their AI index is over 20% average annual returns for median returns. So this is something that's very important you need to know about. It's available. We use it for principal guaranteed. Why don't we use CDs here instead of 7 and 10 in the 7 and 10 year slot?
Well, when you're looking at the purpose of CDs, and it's almost like a general contractor with a toolbox, right? You want to use the right tool for the right job. When you're looking at short-term stuff, 1 year, 2 year, 3 year, 5 year, CDs and money markets, that makes a lot of sense. But as you go further out in your time horizon, you want more upside potential. You want risk is your friend when you have a longer time horizon. So when you're talking about 7 and 10 year strategies, you want variable upside growth with principal guaranteed, with principal protection. So these strategies work very good in medium time horizon scenarios, 7 to 10 years, because they have no downside risk. And like Brian mentioned, the returns on these are very strong, very attractive.
There's one more thing that they do that CDs don't. You can't, if you want to draw monthly income from CDs, every time you pull money from a fixed rate CD, you're going to get penalized. Well, you've got liquidity of 10% per year, no penalty. So we ladder these, we have it grow. This is very good growth. It's principal guaranteed, and we can pull up to 10% per year, no penalty from these accounts. So this is a key part of the laddered portfolio. Now, Mark, we only have 2 minutes left. I asked you about a half hour ago, and this was my fault because we just had so many things to cover. In the last 2 minutes, give a good description of what a distribution plan looks like, A to Z. Just go left to right.
So when you're talking a distribution plan, it is not a pie chart. Number one, you can't look at a pie chart and determine what your distribution strategy is. You have to put it down on paper. You have to account for your fixed income sources. So that's going to be Social Security, that's going to be your pensions, that's going to be rental income, that's going to be any sources of guaranteed income that you have coming into you, and also your portfolio income. Your portfolio becomes your paycheck in retirement. So you have to, using conservative estimates, account for how much income you can generate from your portfolio for the rest of your life. And you can't do that without taking into consideration inflation. The rising cost of food and energy and services is going to cause inflation in your spending every year. So you have to account for that. So when you're building out your distribution plan, it has to be, number one, your portfolio income. Number two, your fixed income sources. Number three, your taxes, because you can't get away from taxes in retirement. Ultimately, what you're trying to arrive at is answering the question, how much income can you generate after tax on an annual and monthly basis? And once you know that, then you can start planning around that number. That is a baseline requirement for distribution planning.
So we covered a lot of ground here today, Mark. Both Marks, we covered risk reduction. We covered the current markets. We covered accumulation and distribution planning. We covered buy and hold strategy. We covered a lot of information. So you can go back and look up the podcast on Decker Retirement website and re-listen to any important parts of this podcast.
And of course, that's DeckerRetirementPlanning.com. And if you just want to give them a call, say, hey, you guys were getting into a lot of deep stuff. I need a little bit better understanding of that because I'm a little confused because there's an hour-long show. They got to go. There's a lot of information. 833-707-3030. Brian J., Mark, it's all about you. How can they help if they can? Decker Retirement. It's 833-707-3030. 833-707-3030. Might be the most important phone call you make, certainly today. 833-707-3030. Brian and Mark, appreciate the time. Enjoy the rest of the weekend.
Thanks, Mark.
Thanks.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.